So in interest rate markets, global debt markets, your dollar denominated debt are competing with other currencies, and of the developed regional economy blocks, you basically got two other competitors in the tier one with the US dollar and US Treasury as its kind of global standard in interest rates. You got the euro and then the yen. Yen, we won't talk about that today. But for the euro, placing its debt in the global capital markets, there's no EU, um, federated debt. That structure does not exist yet. While it may in the future, that's not where they are right now. So when you look at like their benchmark interest rate, right, you foot to the German Bund, right? And if this is, we're getting into football season for the American watchers. It's our national sport. Um, we do things differently here than the rest of the world. Our football is a different game than what the rest of the world considers football, as everybody knows, right? But you're getting into practice, you're getting into training camp, all of that, and you start doing best on best, right? Where your number one offense goes against number one defense, and that's how you get ready for the season. That's what I'm showing here. Our best on their best, right? From the EU standpoint, their best is the German Bund. So if you're looking at these going into the post 2008 environment, we to set right now we've become accustomed to U.S. rates being above the U.S. Treasury rates being above the German bonds, and that's the way it's been essentially for the entirety of our experience since the EU debt crisis that really hit its climax in like 2013-ish. So what we've seen since then, German bonds, the yield wants to suppress. That's due to their banking system primarily having a lot of demand for what they view as their safe haven asset, their highest quality liquid asset (HQLA) for bank reserves and other financial institutions to minimize credit risk. So you've been running a positive spread essentially of the U.S. Treasury versus the German Bund for well over a decade. We're going on 13 years. So if you're looking at interest rate markets, all of that, how do you know? Like if you're the United States and we say Trump and Powell, let's just remove the what's it called, the suspension of disbelief aside. There's no gap between Trump and Powell in reality, right? There may be some on style, right? We all know Trump's personality, very flamboyant, off the cuff, all of that. And Jerome Powell's style, very buttoned up, very professional, what have you. They're both Northeast, long-term American families, or they come from said background. So there's a lot of similarity there in terms of social class, all of that. It's all where I see like if there is an actual gap, it's just purely on style and personality. But in the actuality here, we've compared this, what we're seeing here. Cameron, you called it a Seinfeld, episode. It's also, very similar. You've heard people describe it as like a WWE plot point, right? Where it's like, okay, how do we extend the narrative this week? Ultimately, we want a big, massive showdown at, the highlight event, WrestleMania. How do we develop the plot every Monday night to get there? That's kind of what I view this whole Trump versus Powell skirmish, whether it's just beating him up in the media, patting him on the back yesterday at the on-site construction tour. It's all just it's acting for the camera, right? And ultimately, what you want to get, we know that rates are going to come lower on the front end. That's what this inversion in the yield curve has been showing us for 3 years now. When we say inverted, right? Short-term rates, overnight financing rates like SOFR, Fed funds, et cetera, your T-bills, those are all higher than your coupon bonds with longer dated maturities. Now, we've seen that inversion come out. If you look at like short-term rates versus 30-year, that's been uninverted or positively sloped for a long time now. But we still see that inversion on the front end if you look out to 2 to 3 years maturity, or somewhere about 5 to 7 years. Um, you start to see the short-term rates versus those maturities start to flatten or even become positively sloped. But this is where the market's been telling you, we know there's ultimately going to be further rate cuts coming on the front end, and that's just, it's not a it's not a Jerome Powell, I control this level, I move it. It is true they can cut it, but they can't do what these money markets, like the short term dollar financing markets, overnight funding, all of that. Um, they can't cut them if the overnight markets don't agree, right? If you try to go the opposite way of what the money market wants you to do, you're just going to create some problems for yourself. It's like trying to flush a clogged toilet. Good luck with that. To put back into the construction analogy, right? Um, but if you're looking at interest rates here on the long term to be your guide on where this is heading, I think if you're looking at the 10-year for the U.S. and then the 10-year for the German Bund, what we've been seeing develop in the last um, couple of years is, and then ultimately going back to 2018, 2019, where we saw the high and the German Bund versus US Treasury spread. It looks like we're getting ready for something, right? And if you think about the backdrop, right, you've seen the push from the EU just based on the NATO discussions, which Trump was kind of incentivizing or spurring this action for the European NATO members to fund more of the defense budget. So you've seen them, break on their hesitance to raise their defense as a share of GDP. That's happening. You saw German government earlier this year remove its debt brake, so they're going to increase debt. What we're watching for on the chart, if you look at the orange line on the top, German Bund yields want to come up, like even from where they are right now at sub 3%. If the German economy wants to run up fiscal expansion, more debt, it's going to be associated with higher interest rates. So that will play out into this U.S. Treasury German 10-year spread. You're basically waiting for the bond market to make its move. If you're Jay Powell and Donald Trump, they've been told by the Wall Street banks, we need more time, wait and see, wait for this thing to develop. So we've got to write a few weeks of filler episodes to ultimately get that outcome we want to happen. That outcome that Trump wants to happen and the U.S. Treasury wants to happen is they want to see rates come in on the short term or short term interest rates. So Fed funds, SOFR, those will eventually come down, but we're waiting for the 10 years, those longer dated maturities, to give the signal that it's an all go.
Got it.
And to get there, it may mean U.S. Treasury rates on the 10-year actually come down as well. That everybody's kind of expecting, hey, if we cut short-term rates in the U.S., we may see like something similar to what we saw last September, where the 30-year starts to sell off. That may happen, or it could be otherwise, just given global capital markets, what's happening in the EU, what's happening in Germany, the fiscal expansion there, the ramp up in defense spending. You may actually see German bond yields up, U.S. Treasuries come down because these large balance sheets, financial institutions, they have to make this compare. It's all relative value. Which currency, which 10-year, what are hedging costs, et cetera.